Did you know that companies have never had more choices for downtown office space than they do today? But here's the catch. If they're looking for prime, trophy workspace, the options aren't as plentiful. Welcome to the Commercial Real Estate Insights Podcast. I'm your host, Steve Hamoen. Let's get right to it. The downtown office market is currently experiencing a glut with an abundance of space available for companies to choose from. However, the demand for premium, trophy office spaces remains strong, creating a competitive environment for those high-quality locations. According to a report by Danny Ecker for Crain's Chicago Business, while there's a vast selection of office spaces in downtown areas, the scramble for top-tier spaces is fierce. Companies are vying for these prestigious locations, which continue to attract interest despite the overall surplus in the market. This trend is not just limited to Chicago. In Kitchener-Waterloo, Ontario, similar dynamics are observed. The region is also experiencing a surge in demand for premium office spaces, particularly in tech hubs where companies are eager to establish a presence in the most sought-after areas. The competition for these spaces is intense, mirroring the situation across the border in the United States. In the United States, cities like Chicago are seeing a significant number of office spaces available, yet the allure of trophy spaces continues to drive competition. This is indicative of the broader trend where businesses prioritize location and prestige, sometimes even over cost, to attract talent and clients. The demand for these trophy spaces underscores the importance of strategic location decisions in today's commercial real estate market. A proposal to convert a vacant portion of the Pittsfield Building into apartments has received a green light from the city panel, marking a significant milestone for a project aimed at revitalizing the historic Loop landmark. The Chicago Plan Commission has approved the plan to transform the building's empty office space into 214 residential units. The developer, led by Tom Liravongsa from Grand Rapids, Michigan, acquired 30 out of the 40 floors of the high-rise through a foreclosure sale in 2023. This proposal is part of a broader trend in downtown Chicago, where developers are increasingly turning office spaces into residential units to meet the growing demand for apartments as the need for workspace diminishes. The Pittsfield Building has faced years of legal and financial difficulties, leaving the spaces owned by Liravongsa vacant for about a decade. The project is estimated to cost $195 million and includes restoring the building's terracotta facade and windows, along with plans for a cafe and an observation deck at the top of the tower. According to Rolando Acosta, a zoning attorney representing Liravongsa, the rezoning will allow for the reoccupation of these empty floors with apartments and provide an opportunity to restore this architectural gem. The residential units will include a mix of studio, 1, 2, and 3-bedroom apartments, with approximately 20% marketed at affordable rates, aligning with the city's Affordable Requirements Ordinance. Liravongsa, who is managing director at Electra Global and known as the Skyscraper Guy on social media, is in the process of securing financing for the project. Despite challenges in obtaining debt and equity for large real estate projects in recent years, Liravongsa notes that the debt market is warming up, particularly for conversion projects. The Pittsfield Building project is seen as a unique opportunity to be part of revitalizing a historic building that has been vacant for so long, which has generated significant investor interest. City officials have expressed enthusiasm for the proposal, with Department of Planning and Development Commissioner Sear Boatwright praising the development team's commitment to reimagining the historic space. The Pittsfield Building, a hybrid Art Deco and Gothic-style tower, was the tallest in the city when it opened in 1927 and was designated a city landmark in 2002. In a significant transaction within the commercial real estate market, a 5-building portfolio has been sold for $190 million, marking a notable event in a market characterized by high demand. This sale underscores the robust interest in commercial properties, particularly in regions that are experiencing rapid growth and development. The portfolio, located in a vibrant area known for its economic expansion, was acquired by a prominent real estate investment trust. The transaction highlights the strategic investments being made by major players in the industry, aiming to capitalize on the continuing growth and stability in the commercial real estate sector. According to Kaylee Thompson from the Triangle Business Journal, this deal reflects the confidence investors have in the long-term potential of the market. The buildings included in the sale are primarily leased with long-term agreements, which adds to the appeal for investors looking for stable and predictable income streams. This trend of securing properties with existing tenants is becoming increasingly popular as it provides immediate cash flow and minimizes the risks associated with vacancy and tenant turnover. As we look at similar dynamics in the Kitchener-Waterloo, Ontario area, the appetite for commercial real estate remains strong. Investors are actively seeking opportunities to acquire properties that promise consistent returns. The region's growth, particularly in tech and innovation sectors, mirrors the expansion seen in parts of the United States, such as the Raleigh area where this recent transaction took place. This cross-border interest highlights the interconnected nature of the commercial real estate market, where investors are not just limited to their domestic markets, but are also looking internationally for lucrative opportunities. The sale of the 5-building portfolio is a testament to the vibrant market conditions and the strategic movements by investors to secure valuable assets amid a competitive landscape. In Columbus, Ohio, the Arena District continues to be a focal point of development activity, with multiple projects underway that promise to reshape the landscape. The area has long been a hub for both commercial and residential growth, and recent developments are set to enhance its appeal even further. Among the key projects to watch is the construction of a new office building that aims to attract tech firms and startups. This development is part of a broader initiative to position the Arena District as a leading destination for innovation and business. The demand for modern office spaces in the area reflects a trend seen in tech hubs globally, including the Kitchener-Waterloo region in Ontario, Canada, where similar efforts are being made to draw in cutting-edge companies. In addition to office spaces, the Arena District is also seeing significant investment in residential properties. A new apartment complex is being developed, catering to the growing population of young professionals and families seeking vibrant urban living. This mirrors the multi-family residential growth observed in cities like London and Cambridge, Ontario, where developers are responding to increased demand for housing in key urban centers. Retail development is another major component of the Arena District's transformation. New retail spaces are being integrated into mixed-use developments, providing residents and visitors with a variety of shopping and dining options. This aligns with trends in other major metropolitan areas, where retail is strategically combined with residential and office spaces to create dynamic, livable communities. The fourth major project in the Arena District involves the expansion of entertainment facilities. This development is expected to boost tourism and local economic activity, drawing visitors from across the region. Similar initiatives in the Kitchener-Waterloo area have shown how entertainment venues can play a crucial role in revitalizing urban districts and driving economic growth. Overall, the Arena District's ongoing developments highlight the importance of strategic investment in urban centers. By focusing on a mix of office, residential, retail, and entertainment spaces, the area is poised to become a model for successful urban revitalization. This multifaceted approach is gaining traction in cities across North America, including those in Ontario, as communities seek to create vibrant, sustainable environments for businesses and residents alike. In recent developments, Pure Multi-Family REIT LP has officially terminated its potential sale process after the only remaining bidder withdrew its offer this week. This decision comes after a lengthy period of negotiations and evaluations that began in April following unsolicited takeover offers from United States-based multi-residential investor Electra America. These offers were initially rejected by Pure Multi-Family's management, who believed they were undervalued and sought to attract a higher bid. The management of Pure Multi-Family has shifted its focus back to its existing operations, while also considering future strategic opportunities that may arise to maximize unit holder value. The announcement had an immediate impact on the company's stock price, which saw a decline to $8.47, approximately a 10% drop, during mid-morning trading on the Toronto Stock Exchange Venture Exchange. Throughout the bid process, Pure Multi-Family's board and a special committee dedicated to the sale held over 50 meetings and consultations with interested parties. With the assistance of financial advisor Scotiabank, they reached out to 86 potential buyers, of which 24 signed non-disclosure agreements and gained access to the REIT's data room. Despite this interest, only 2 bids were received by the initial non-binding bidding deadline in June, with the highest offer at $7.71 per share. Following extensive site visits and examinations by the interested parties, no bids were submitted by the closing date in July. However, one potential bidder requested a meeting outside the formal process, proposing an offer of $7.64 per share, which was lower than their initial Phase 1 bid. After further negotiations, this bid was ultimately dropped on August 23rd. The announcement marks the end of a 9-month process that demanded significant time and resources from the REIT. Electra America, which initially submitted a bid in December, saw its offers rejected, leading to a series of public statements by shareholders and the subsequent exploration of a sale. Vision Capital, a major stakeholder, supported Electra America's bid, while Sandpiper Group expressed confidence in Pure Multi-Family's assets and management. Electra America, based in North Palm Beach, Florida, operates in the U.S. Sunbelt multifamily market and has a history of significant mergers and acquisitions. Pure Multi-Family REIT, headquartered in Vancouver, focuses on luxury apartment communities in the U.S. Sunbelt, with properties in Texas and Arizona. As of December 31st, the REIT owned 22 properties with over 7,000 residential units, maintaining a high occupancy rate of about 95%. Thank you for listening to the Commercial Real Estate Insights podcast. I'm your host, Steve Hamoen. See you on the next one.